going to discuss about the soft capex flurry, how much of it is really a reality and what really is India Inc. actually witnessing on ground. So let me first welcome on board Manish Bhatnagar, the MD at SKF India, and kickstart discussion with him. Manish, hi. Good to have you on the show. Capex slowed down in FY21 because of the pandemic. Do you sense that now there is a big revival which is currently underway? What is your own reading of how the on-ground situation is really panning out?
Yeah, so SKF, thank you first of all for inviting me here. But SKF has businesses in the industrial space and the automotive space, and it's 50-50. On the automotive side, we've seen an extremely strong recovery on two-wheelers and agricultural linked, so things like tractors, etc. We have not yet seen the recovery in commercial vehicles, which we think is still about 2 years away. And those issues, of course, go back to before this crisis with the axial load norms, etc., which predate going back almost 18, 24 months. On the industrial side, we have seen recovery a bit muted, if I may say so, compared to automotive, but picking up steam. Everything linked to infrastructure, so steel, cement, construction equipment, etc., has seen a stronger recovery. The others have lagged behind, but we expect that to pick up in the next few months.
Is it largely the rural end of the market, Manish, which is actually leading this recovery? And do you sense that for the next foreseeable future as well, this is going to continue to be the trend?
We've had a very strong farm produce. The crops have done very well. The monsoon has been strong. So certainly the rural economy is firing on all cylinders. On the automotive side, we've seen pickup in demand for two-wheelers. Again, the lower CC commuter two-wheelers on the rural side. We have not seen a pickup as yet on the higher CC two-wheelers, which are predominantly urban-based. And of course, tractors are very, very strong. So yes, I would agree that on the automotive side, it's rural-related. On the industrial side, it's on the back of significant infrastructure investments by the government. So, new roads, ports, etc., all those have a multiplier effect on the economy. And we're seeing that on the industrial side, which is rural and urban.
Okay, fair enough. Manish, are you also, if we take a look at railways, for instance, they continue to be a large opportunity led by a thrust on freight bearings in particular. What's the potential of growth via that route, via focusing on the rail segment?
That's a good question. Railways is an interesting phenomenon. We are possibly the only large country of its size where we do not use the railways as a good freight mover. In our logistics costs are about 14% of GDP, which is about double what it is in other comparable countries. And the reason for that is almost 65% of our freight goes by road. It should go by train and it should go by sea. And now we are seeing investments in the so-called DFC, the dedicated freight corridors. Two of those corridors are set to go live very, very soon. Those contracts have been awarded. So as those freight corridors start going live and we start seeing more freight movement via train, number one, our freight costs, therefore our logistics costs will go down. And that's good news for the economy all around. And certainly for SKF, we are a strong player in the freight business. We want to be stronger, of course. And you rightly said, freight bearings used on freight wagons are margin accretive to us. So we hope to see some good news there.
Great. Given that nearly 35% of industrial bearings are sourced locally, and of that 90% in fact is from SKF, do you see increased localization for industrials in the long run?
Well, not just in the long run, I think in the short and the medium run. So again, to put the numbers in perspective, 50% of our business is industrial, and you're right, 35% is is local. So we need to increase that to at least 60, 70%. And the problem with industrial is, unlike automotive, industrial's bearings are fairly small volume. When I say small volume compared to automotive. So these could be sometimes as small as 5,000 bearings a year, a good example being the railways, or even if it's 100,000 a year, it's nowhere close to the volumes of automotive for reasons we can understand. Industrials cut across many, many segments. So yes, in the short to medium term, our big investment, our big capex will be focused on increasing localization for industrial bearings. We do want to get that business up to at least 70% localization for cost reasons, of course, but also more importantly for meeting customer needs. Customers really don't want to wait for 4 weeks or 2 months to get a bearing. They would much rather have it manufactured in Pune or Bangalore and be shipped to them as soon as possible, like we do with automotive bearings. So that is certainly a big focus for our investments in the next few months.
Okay, let's move on and let's continue with the CapEx revivals theme. And we've got with us now Manish Gulati, the CFO at HEG, to talk about the Soft Capex Flurry. Manish, hi. Good to have you on the show. Steel companies, Manish, have been ramping up production clearly. Some have also reached the pre-COVID levels. What's the sort of demand that you are seeing on ground?
So we as graphite electrode manufacturers are suppliers to steel industry for the electric arc furnace route. And the more steel is made, the more electrode demand occurs, as about 1.8 or 2 kgs consumed for every ton of steel made. So for the last 2 quarters, we are seeing in India as well as overseas, the demand for steel going up, the economy is reviving, and that is translating into demand for graphite electrodes. When the COVID struck in March last year, we were in the April to June, we were working at 50%. Then in the next quarter, July to September, we were around 70%, October, December, 75%. And Jan to March, we are going to be 80%. And next year also, we foresee that kind of growth. And and about the capex, we had a capex of about 1,200 crores, which we had put on hold in the month of May last year because of lack of visibility due to COVID, which has now been resumed and it's going full swing. So we are very optimistic about the demand revival and the sustainability of demand.
Sure. This is what's happening domestically, but could you also give me a color on whether or not export demand is looking as robust?
Yes. In the rest of the world, the capacity utilizations of steel companies, which had fallen to almost 55 to 60% levels when the COVID struck, is now back to between 70 to 75%. So we are seeing a demand revival growth in our export markets also.
Okay, fair enough. As steel companies do continue to increase capex as well to cater to higher demand, do you see that trend continuing? Where are we in terms of the recovery in demand?
I think this year is going to remain that way because there was a lot of pent-up demand from last year. And if the COVID situation subsides and vaccinations do happen and this impact is over, I think this demand for steel, etc., is sustainable.
Okay. And, in this last year, steel production via the EAF route, which also uses GE, did see a little bit of a dip. What is the reason for this, according to you? World over as well, we saw the same trend.
Yeah, absolutely. See, electric arc furnaces are very quick to regulate because they're a batch process and you can regulate in a day's notice, while blast furnace is more of a continuous operation type of furnaces. So whenever any downside or upside happens, the electric arc furnaces are quick to adopt. So that is why you did see a dip, but you'll see upswing as well.
Tarak, hi. Good to have you on the show. firstly wanted to understand how the glass line segment is currently doing for you, whether pharma demand versus specialty chemical and agrochemical, and how these three parameters are really shaping up.
Thank you for having me. So I think these industry segments are investing. They are growing. So for us, the order book continues to remain very strong. Over the last maybe 18, 24 months, we've seen chemical and, like you said, agro and specialty chem really invest heavily. But now what we are also seeing is that pharma is showing some kind of a comeback as well. So pharma is definitely picking up API, bulk drugs. There is this anti-China rhetoric. There is this kind of making ourselves more self-reliant here in India. And hence the Indian pharmaceutical industry is also looking to invest now, which is a good sign for us going forward.
Could you also help us understand how the acquisition in EU is panning out? What are the synergies that you're seeing flow through? And are you anticipating more orders from this geography?
Right. So I think a couple of things that have happened for us. I think we bought out one of our competitors in Hyderabad. So that factory is up and running since October. So we're going to get additional output from that to serve for the local market in Hyderabad and Vizag. After that, a few days ago, actually last week, we closed the transaction to acquire the parent, the Pfaudler Group. So that basically consolidates all the global Pfaudler revenues into GMM Pfaudler now. So really the size and the scale of the company will change significantly. There are markets where Pfaudler is not very strong in, Southeast Asia, Middle East, Africa, where GMM was restricted earlier. Now these markets will open up for us. So that's definitely an upside that we're going to do. Plus, from the capacity standpoint, we also commissioned 2 gas furnaces in Q3 actually. So that's going to help us improve profitability as well. So all in all, I think we are in a good the position to take some of the market share, kind of grow the business and really go after new business as well from our customers.
Okay, great. In terms of the kind of, segment-wise breakup as well, share with us that the glass segment, pharma demand versus specialty chem, agrochem, just really how you're seeing across pockets, engineering products as well.
Right. So I think historically, pharmaceutical has still been our biggest industry segment for glass lining. About 60% of our revenues would come from pharma. But over the last few years, we've seen that reduce significantly. So chemical has really been on a fast investment cycle. Chemical, like you said, agro and specialty chem have put up back-to-back projects. A lot of movement of production from China to India was driving this. Now we see a resurgence in pharma. So pharma is now up to 45. Nearly half of our business comes from pharmaceuticals. A lot of API plants, especially in South India, new plants coming up, new capacities. And what we are also seeing, which we haven't seen earlier, is the second tier pharma, the guys who supply intermediates into the bigger pharmas. Those guys are investing as well. On top of that, we've seen some kind of diversification as well. So many chemical companies who were predominantly in chemical are now also getting into intermediates. So there is definitely that going on as well. So all in all, I think both industry segments will remain very important for us, and we expect investment in both these industries.
In terms of the guidance as well, and on both revenues and margins, if we were looking at the following year, the full year, what's that looking like? Derek, would you be able to share some numbers with us?
Yeah, so I think we've actually guided that on a full year basis, FY21, the combined group will be around 2,000 crores. Currently, GM and Pfaudler, until the transaction was closed, about a 600 crore company, so about 2,000 crores with about a 13% EBITDA margin. That's a little bit on the conservative side. We have synergies that are going to kick in as well. So we expect a good amount of improvement in margin profile as well. But yes, so as a GMM standalone company, we expect the same level of growth that we've been enjoying for the last few years. Order book remains much, much higher than what it was same time last year. And what's also working quite well for us is that the global business of Pfaudler has seen a good amount of order intake. So like when we speak about India investing and becoming back strong, we've seen a lot of investment in pharmaceutical, both in Europe and the US. And that really bodes well for the Pfaudler Group international business.
Okay, and Tarak, just give us a sense as to what your outlook is as well when it comes to the overall price increases, given that whether or not you're looking at any price hikes in the next 2 to 3 months?
Right. So a couple of things have happened here. So the cost of our main raw material, which is carbon steel, has increased. We usually try and pass this on to our clients as well, because this is really not in our control. At the same time, we have cost reduction measures going on. So natural gas, which is one of the biggest uses that we use in the furnace, has gone down significantly as well. But as you know, so the need for glass-lined, the market continues to grow. There's limited capacity, so it is definitely the seller's market, I would say. So having said that, we will try and pass on the price increases to our clients as well. But at the same time, we have to be careful that, once we're trying to grow our market share, we have to be a little bit careful on that front as well.
Ranveer Singh is with us. Ranveer, let's talk about Capex first, how you see that moving ahead, whether or not you see increasing Capex as auto demand is going up, so what the outlook is for the industry currently.
Thanks for inviting me today. Actually, the overnight sudden demand increase is there all over, basically from domestic also and for export also. There's a very strong demand from North America, European and Asian countries. So as far as in GNA is concerned, actually in last 2 years, we have done quite a large Capex that was around 150 crores. And whatever capacities we have added in previous 2 years, those were quite flexible capacities, and we were able to articulate our flexibility for different segments of market.
Soft Capex as well, how do you see that increasing across the sectors? Do you see more capacity being needed?
Yes, definitely. But whatever Capex we are doing now in next this year or coming year, that will be from internal accruals only. And basically, the large Capex was required for the forgings. So that is a backbone of the company, which we have done already in the last 3-4 years. So, and this kind of capacity needs a lot of lead time also. From that angle, we are very much comfortable. And whatever debottlenecking is happening, and it is a continuous process on quarter-to-quarter basis. But as on date, none of our customer is, with any gap of supply. So we are able to supply our customers, whether it's in North America or Europe or India. So we are able to fulfill their demands.
Okay, and auto ancillaries as well, Mr. Singh, are seeing increased export demand. Is that an important area for which the company is going to need Capex? What is the outlook here?
Actually, as I have explained, already we have done a lot of Capex in our forging area, which is the very long lead time area. But the rest of the Capex for balancing machines or debottlenecking, it is going on. And what we are, if you see the outlook of the company, since last 3 quarters, company, every quarter we are surpassing our sales as the previous quarter, and it will continue. And as so far as visibility is concerned, in next 2-3 quarters, the visibility is very good, whether it is domestic front or export. So overall, this calendar year, I would say, will be very good as so far as demand is concerned. On other end, there are a lot of challenges about the inflation, like input cost of the raw material, so which has gone up in last 5 months. It's more than 20%, so which is really affecting the bottom line also. But it is especially this quarter, recently they have increased the prices, steel prices, by 12 to 15%. And on other hand, demand is increasing. These are the real challenges for next 2-3 quarters.
Okay, fair enough. And given that you're talking about improved visibility on the export as well as the domestic front in terms of demand, can you give us some sort of a sense as to what the projections are by way of your overall revenue growth, the run rate at which you can potentially operate at for the year ahead?
This year, because of the Q1, it was totally washed out. So we will not be able to. We are trying to touch our previous year's top line. On the other hand, we have done a lot of improvements to improve our bottom line. And there we have shown, company has shown tremendous improvement in last 2 quarters. So as far as coming financial year is concerned, the outlook is very, very good. I would say our company is not only depending upon the auto sector, we are depending on different sectors like tractors, off-highway business in our country, in domestic, which is really performing very well and demand is very strong. And in export, we are 70 to 80% our dependency is on CV market, which is again in North America class and other classes are doing very well. And for 3 quarters, we are having good visibility. So next year, we are very hopeful to increase our sales by more than 25 to 30%. I would say in a year 22. But 2021 will be sort of flat.
Okay. Just an extension of that point, Mr. Singh, do you also, think with input costs actually going up in the near term, prices will eventually go up as well?
Yes. As we have long-term contracts with our customers in North America and Europe, those are 5-year contracts. And part of the contract is that our steel, whatever variation is there in the steel, it is not immediately implemented. It takes 3 months or on quarterly basis. With North America, it is with their local index, metal index. So if our Indian and American prices are not simultaneously increases, so then some effect comes on our bottom line also. But company with the high volumes, we are trying to recover those gaps, so that our bottom line should be maintained.